Welcome back, everyone. My name is Bruce Butterow. As Anna mentioned, I'll be taking over and guiding you through the remainder of today's program. I must comment that the first panels of the day certainly made it worthwhile to get up at 4 a.m. to hear the speakers. The last panel we heard from certainly set the stage in terms of our discussion regarding DLT, and our next panel will continue that discussion, where they will share their views on the traditional cash leg settlement using a CSD DLT platform. Talk about what are the options available, what partnerships are necessary for success, and how to ensure the finality of settlement on and off the chain. They'll discuss interoperability in the environment as well. So please welcome to the stage Mark Jem, who we heard from yesterday, EXTA and WFC chairperson and head of Clearstream Risk Committee. Over to you, Mark, to lead this discussion.
Thank you, Bruce. Welcome, everyone. What a great time to talk about this a month when we found out that stable coins are not as stable as some people had thought, but that will not distract us. So I'm delighted to introduce our panel. We're going to have Isabelle Delorme from Euroclear. She's Deputy CEO of the CSDs. So hi, Isabelle, great to see you. Early in the morning in New York, we have Robert Palatnik of DTCC. So Robert, who's the managing director on the innovation side there. Welcome, Rob. Good to see you. We have Vipin Mahip Singh, who's joining us from Mauritius, where he runs the Mauritius CSD. Vipin, great to see you. Welcome. And we have Romram, who runs Finality, specializing exactly on the topic that Bruce has just introduced. And last but by no means least, we have Oliver Sigrist from the Innovation Hub of BIS, joining us, I guess, from Basel, Oliver. So welcome. And with that said, what we're going to do is panelists each going to introduce themselves. And for those who have live projects, we're going to quickly hear about those projects, because it's absolutely, I'm an absolute antediluvian in this sense. I believe that, you know, the only worthwhile innovations we've seen in financial services have been the invention of double entry bookkeeping and the invention of the telegraph. So it's quite stunning to me to see exactly how much progress you guys are making. So that said, if I could ask you briefly to introduce yourselves. So Isabelle, and I understand that Euroclear has been involved in a couple of projects here. So if you could briefly say, and this goes for each of you, you know, what you're working on in this space, what you hope to achieve, and what your current status is, that would be great.
Yeah, sure. Short introduction, I'm the Deputy CEO of ESES, meaning Euroclear, Belgium, France, and the Netherlands. I'm domestic CSDs in those three countries and grouped under the umbrella of ESES as a common name. I'm here today because I think I've been involved in many reflections that we currently have at Euroclear around the benefits of blockchain and DLT in the post-trade. Some of you know that we experimented concretely what it means for the of tokenized assets since we participated to the experiment launched by Banque de France 2 years ago. And we proposed to issue and settle OATs, so French sovereign debt against BDC, issued by Banque de France at the time for the experiment. And indeed, we learned a lot, and especially how market reorganization, in the sense that you organize a much more direct participation to post-trade thanks to those technologies, can bring in terms of efficiency, safety, and new ways of collaborations. And since then, because it was 18 months ago, since then we have built a few working groups internally. I cannot comment on everything, but we continue exploring the benefits of those technology is in the core services. So indeed, issuance and settlement, but also additional services that we can bring as a market infrastructure.
Super. Thank you, Isabel. So absolutely fascinating to hear the role of the Banque de France and the central bank digital coin in that context. And maybe that would be the right moment, Oliver, to ask you to introduce yourself and briefly the project that you're working on, what you're hoping to achieve, and what your current status is.
Yeah, thank you very much. So I'm joining here from the, actually I'm in the Zurich office today and not in the Basel office. We have offices in both locations. I'm joining here for the BIS Innovation Hub. I'm an advisor there. So I'm sure you're all very familiar with the BIS. The BIS has been promoting monetary and financial stability through international cooperation. Now, for the last 2 years, we have also started doing innovation. So the Innovation Hub started with 3 centers, one in Hong Kong, one in Singapore, and one in Switzerland. Now we have added additional centers, and there will be more centers added in the course of this year. So in general, so very briefly, what do we do? I think summarizes very well. So I think we pioneer central banking. We move the production possibilities of central banks with technology. So we very much focus on practical work. So we do proofs of concept, we do prototypes, we do minimum viable products, and share them with the central banking community, but also with the general public. So now today I will we do projects in various fields. Today I will add kind of the central bank perspective to the discussion with a particular focus on wholesale CBDC. So we did 2 big projects, 2 big wholesale CBDC projects. One is Project Helvetia, and the other one is Project Jura out of the Swiss Center of the BIS Innovation Hub. The Project Helvetia has a domestic focus and thinks about the issuance of wholesale CBDC on a DLT-based CSD, and the other one has a more kind of a cross-border focus. It was joint work with amongst others with Banque de France, and as I said, so there the focus is on PVP settlement of Euro wholesale CBDC versus Swiss franc wholesale CBDC. So I think that's kind of the basis where I can add to the discussion. So wholesale CBDC projects in general, both domestic and cross border.
That's Oliver, thank you. Rob, if you could introduce yourself briefly and the project you're involved in, where you're at and what you're hoping to achieve.
Sure. Thank you very much. So Rob Palatnik, I work for DTCC, Depository Trust and Clearing Corp, from the United States. I lead our global innovation, research and innovation team. I've been at DTCC a long time, so I've been involved in a lot of the original systems that we developed, and now I get to disrupt them. I'm going to talk about 3 different efforts that are going on in DTCC. We did start in the blockchain space in around 2016. We were a founding member of Hyperledger. I just finished my 3.5 year as chairman of the board of governors of Hyperledger, which is the premier open source enterprise DLT community. And within DTCC, we're working on 3 different initiatives, which are each interesting in their own merit. One is a replatforming of a mainframe application from traditional mainframe to DLT. Second is brand new service that DTCC is bringing to market. And third is an evolution of our equities clearing space. So on the mainframe replatforming, we've been involved in an effort to take our trade warehouse for credit default swaps and move that to a distributed ledger. That project has lasted a number of years, and we had to work with a number of others in the community and in the industry that also provide services to make sure we're coordinated with our release, and we expect to be live later this year. The interesting about that from a cash settlement-like perspective is, besides being a warehouse for credit default swaps, we net the payment streams that are associated with that, and then we help settle the payment streams through various payment rails, which DTCC connects to. Second system that we're bringing to market is what we call DSM, Digital Securities Manager. It's a new service for DTCC that will bring private market offerings or pre-IPO securities to a centralized book and record of standards and gold copy, but we will allow optional minting of those securities on public networks, like public Ethereum is the target for one of the first releases. And the smart contract will say that if this transaction occurs between two parties on that public network, it must go to DTCC for approval. And then we will apply our rules engine to verify that it complies with the appropriate regulation for that security. So that'll be a new service, and payments will be involved in that. And the third thing that we're building out is a system called Project Ion, which is, I'll say, the very first small step in moving our equity clearing and settlement capability to DLT. We're adding a parallel processing path for bilateral trade. So we're trying out a small portion of our processing flow with modest transaction volume. We had built a prototype last year, and over a dozen firms jumped into the prototype that allowed full clearing and settlement integrated on DLT. And the success of that drove our clients to say we should progress this model of moving transactions onto a ledger, allowing clients to adopt ledgers, and enabling DLT as the platform of golden record of the securities transaction. And as per our model, settlement occurs today, end of day, but the Ion prototype model will eventually get us to optional either real-time gross or multi settlements within a day, multiple nets potentially within a day. So a number of different models, and we're using the Ion prototype project for a project with the digital dollar project called Project Lithium. And Project Lithium is going to be our integration of equity wholesale clearing with a central bank digital currency. And it is right now an experiment. So Project Lithium is not a go to production system. It's an experiment, but we're trying to leverage the work we've done on the equity space to see what impact a central bank digital currency could have.
Super. Thank you, Rob. That sounds extraordinarily rich, but also a very practical agenda. So, Vipin, if I could turn to you next to also introduce yourself, and I'm intrigued what CSD Mauritius is doing in this space.
Thank you, Mark. Yeah, so I'm the managing director of the CSD Mauritius. We also run the trading system of the stock exchange of Mauritius. I've implemented trading and settlement systems at a number of African exchanges and depositories. So my approach generally is to achieve cost effectiveness by aligning systems, processes, business case, and legal framework. And it is from this angle that I'm looking at DLT and digital assets. Mm-hmm. So I'm trying to really have a solid understanding of DLT to be able to differentiate between the hype and the real value addition of this technology. I think that the fundamental question that needs to be answered is whether it is more cost effective to issue and trade securities in tokenized form rather than book entry form. And I think that at this stage, there's not enough empirical evidence to support this. I mean, you can just see DLT has not really taken off outside cryptocurrencies. So it's good that there are a number of experimental projects that are being launched. I think that's a very good a good thing, and eventually it can eventually show some evidence. But I think there's also a lot of fear of missing out. Sorry for being controversial, but that's the way I am.
That's great. You know, on these panel discussions, we court controversy. It's wonderful and interesting perspectives there to keep us honest. And so, Rom, I'm guessing that you're hoping to prove Vipin wrong. Perhaps you could introduce yourself briefly and what Finality aims to achieve in this space.
No problem. So thank you very much, Mark. And thank you to the organizers also for inviting me. Delighted to be here. And Vipin, thank you very much for providing the foil I hope that we'll become during the course of this conversation. So my name's Ramayas Ram. I basically am a former Deutsche Bank executive. I spent 22 years at Deutsche, probably 50-50 between running various foreign exchange and electronic trading businesses and capital markets. And then the last half running global product management for transaction banking. Since 2017, I've been involved in something that was known as utility settlement coin and is now personified by the company Finality, and I've been the CEO since the company kicked off in 2019. So what is it that we're doing, and kind of why is it relevant to all of this? We're building a global peer-to-peer, so DLT-based wholesale payment infrastructure in a number of key currencies. The key currencies are sterling, dollars, euros, yen, and Canada. But if it all works out, the hope is that we go further than that. Our payment systems will settle kind of real-time tokenized payments in a single currency, as well as foreign exchange or cross-currency transactions. They'll also provide, and this is the relevance to this conversation, the tokenized cash leg for the settlement of securities transactions. In terms of shareholders, our shareholders are mostly globally systemically important banks, so the GSIBs, and they've seen for some time and continue to see a need to have a safe, regulatory compliant digital cash settlement asset in a world where financial assets are increasingly tokenized. So there's a view amongst these shareholders that we're on a journey. The journey might be starting with them, or it might be starting in the crypto space, but we're not near the end of that journey, and they want something that's recognized within the regulatory community. Overall, our particular design, and this is not necessarily true of all designs of DLT type systems, will lower risk and increase efficiency essentially by reducing the need for a number of intermediary parties. And I guess the best way that you can think about what we're doing is, while we're not a CBDC, obviously only central banks can issue CBDC, you could think of what we're doing as creating a network of interoperable synthetic CBDCs.
Right.
So I'm going to stop there. That's probably created more questions than
lots
answers.
to unpick there, Ron. Lots to unpick. So before we get into the meat of the discussion, a reminder to the audience, we decided we're not having poll questions in this session. And I think, judging from the introductions, you can see why. The experience in this room is extraordinarily rich. But what I would ask is that if you have questions, please don't hesitate to post them, and we'll get to them in the course of our discussion. So we've heard here that, and what's stunning for me is just how practical and advanced some of the experimentation and the practical applications of this are, even in the context, the narrow context of the question, which is the cash leg. So I'd like to start with the element of disruption. So we often say that our current post-trade infrastructure is really based on the role of trusted parties who can host the book on which book entry settlements occurs. And, obviously CSDs are central to that. So my first question to the panel is, how will the use of digital coin, central bank coin, in the cash leg of settlements modify that? Will there still be a need for a trusted party to host the cash leg of the settlement, or do we see this as disruptive for the CSD industry? And I think probably I should turn that question first to you, Rom, because you're somebody from outside the CSD community.
Yeah. Well, so the simple way to say it is I think there will be a need for CSDs, but I suspect that the role that they play may be modified over time. So if you have any kind of registration of securities, somebody's got to be accountable for making sure that that registration's appropriate and all, kind of all the other things that CSDs do. And speaking about it today, it's hard, even though DLT claims that it could remove the need for all of these different entities, and that you could have the network kind of completely trust that. If you're going to have some sort of FMI, an FMI needs a system operator, and for securities, I can't see who would take their place other than the CSD. So what the specific role of the CSD in that might be, I'm not 100% sure, but I can't see that you won't need CSDs in some form, taking accountability for this type of business.
That's interesting from somebody coming from outside industry, perhaps comforting. And Oliver, you're also sitting a little bit on the margins, not representing the CSD, but a community that's obviously very close to the CSDs. Do you see that the same way as Rom, or would you have a more challenging perspective?
Well, I agree with Rom, and I could maybe add kind of looking at this public network press or kind of public blockchain environment. There, I think trust is still needed, but I think the role of the different participants and of these participants that builds trust, these change. So I just two examples. Like now we need trust in code and protocols, and this trust can only be established by, for example, through security audits. So you need companies auditing code protocols. So you also need trust in them, right? So because validation is very complex, and it's actually very few people who can do that. And then the second aspect of trust that enters in this public networks is you need trust in. So if you want to put your keys in custody, you need trust in this setup or in this entity that holds your keys. Now, in the past, this was about trust in custody of assets. Now it's trust in custody of keys. So I would say trust will still be needed, even though it might change.
Mark, if I may.
Please, Vipin.
Yeah, I think it's important at the very outset to I think there's a myth about this decentralization. I think we use this term wrongly, because the real decentralization occurs only with DeFi, decentralized finance, where you use decentralized apps, where you don't really need any intermediaries. But we all know that decentralized apps are mostly not regulated. Non-custodial wallets are not allowed in many countries because they do not meet AML and CFT requirements. At the end of the day, you don't really know who owns the app. Is it a community of users? Who is liable eventually? So we know that decentralized app for the time being is not there. So then everything else, whether you are talking about crypto exchanges, you're talking about SDX, you're talking about whatever, it's still centralized, right? So you still have an exchange. What is happening is that the trading and settlement function is probably being combined in a single entity or in a single system or a single platform. Given this can be done even currently, there's nothing that prevents us from being done. And the other thing is with decentralization is that we are not really seeing what we still have intermediaries. You still have intermediaries. You still have intermediaries who have to do KYC, who need to do AML CFT verification. So I think the disintermediation thing is not there. There are intermediaries, there are parties, maybe different roles, but there's no complete disintermediation, at least, I mean, for the next 10 years, I think.
So,
yeah, I may say it.
Sorry, Isabel, please.
Yeah,
I was going to indeed ask you there as to how you saw those roles being transformed, given, especially as you sit across three markets.
I will use different terms, but I think in a way I converge with what you said, Vipin. But to me, the word disintermediation is not interesting as such. What I experimented together with my colleagues at Euroclear is that using DLT to issue and settle tokenized assets, for sure, how to say that, the dependency to trusted parties will reduce. To me, it's a fact, because the processing part is highly simplified by the simple fact that the current participants of the post-trade plus their clients and their clients of their clients access the loop, access the DLT where the post-trade is processed. By this simple fact, the number of bilateral tasks, processing tasks, reconciliation tasks, all the burden that we have to manage every day will shrink. It will decrease dramatically. So to me, the need for trusted parties as intermediaries of the holding chain or intermediaries across the processing chain will decrease. And as a consequence, the need of trusted parties for this technical side and processing part will decrease. What I see a remaining role for trusted parties, and be they CSD or other entities, let's forget that we are CSDs for a while. There is a need, to me, for an entity bearing responsibility for the good execution and for access management. This is, as a matter of fact, you cannot call a node to discuss what happened because you don't see the condition processed, or you don't see all your tokens anymore. You cannot ask a node or a DLT network or platform to bear the responsibility for itself. So I think a trusted party bearing responsibility for the good execution, for the access management, identity management, and the application of all regulatory requirements sound inevitable.
That's interesting. And from what you're saying, Vipin mentioned earlier that he doubted, or at least you're skeptical that there is that this is going to be as cost effective as book entry settlement by postulating, Isabel, the fact that the number of bilateral interactions across the market will be quantumly reduced. You're kind of outlining where that business case would be found. So maybe I could ask Rob if you agree with that. You're also sitting the only one that's larger than ISIS and a couple of other European CSDs. So what's your perspective on that?
Yeah,
Is the business case found at the expense of other interactions in the market, or is it more likely to be found within the cost base of the CSD itself?
Yeah, it's, I mean, I think we're an operating organization like many of my peers in the industry, and I'm an engineer by education. I haven't studied fortune telling, so I'm not really that good at predicting the future. What I do believe is as Oliver said, trust doesn't go away in this new ecosystem. It's, now the theory is you're trusting math and you're trusting programmers and you're trusting something else, but those that you still, if any retail or institutional customer of the financial industry wants to know that when they make an investment, it's protected, and they want to know that the regulators are overseeing it in the right degree, and that the parties involved are adherent to appropriate, laws and rules, and that's really in the end what matters. When I look, I'll say, at some of the alternative financial ecosystem that's evolving in the crypto space, I don't see intermediaries going away. As a matter of fact, I see more intermediaries than I've ever seen before. I see, key holders and wallet makers and so forth. There's 14,000 cryptocurrencies and there's 180 countries. So before cryptocurrencies, we had 180 currencies, or I'll say a good number of currencies, more or less per country. notwithstanding euro and some others. Now we have 14,000, and is the end game that there's a currency per human? And does that make sense? Does everyone want to carry around 100 million keychains to understand that every interaction with any person they encounter might be a whole new exercise in interoperability? So I'll say the engineering math of complexity, for most of us, I think on this panel, doesn't make any sense. The goal is simplicity. The goal is adherence to rules and laws and regulations, and the goal is appropriate oversight and appropriate risk perspective, and it's resiliency, it's security, it's making sure that we never lose a penny or a euro or a yen of every transaction, and that in the end everything is accounted for. I think the technology has tremendous potential. To Isabel's point about reconciliation, I mean, the notion of trust and the notion of intermediaries was never supposed to be about reconciliation. The fact that we each have our own version of the database, and then at the end of the day we have to reconcile it with each other, is just a technical implementation that we've created over the last 30 or 40 years. That I hope can go away, and I think DLT provides a lot of promise in that space. But I believe there will be a need for trust, regulation, overseen entities that make sure things work right, because at scale things fail, and somebody needs to be able to fix things when they get broken in the middle of the night.
To your point, Rob, about a currency per person, I think the Alphaville in the FT tracks that the number of digital coins being introduced runs at between 3 and 4 every single day. And they have great fun tracking those that last less than a week. But Oliver, I think from your point of view, there's a substantial difference between these so-called stable coins, private stable coins, and central bank digital coin. Do you see that there is any future for private coin in this space, or are we really, when we talk about the cash leg of security settlement, whether on or off ledger, that we are talking about central bank digital coin to the exclusion of others? And obviously, Ron will have a view on that question as well.
Yeah, this is a good question. So I think, well, at least, so how I see it, I mean, from in a wholesale setting, I really see the need for settlement in central bank money. So that's how markets are organized today. Typically now you use an RDGS system to settle obligations between financial institutions. In the future, it could just be another form of central bank money, a tokenized form of central bank money. And I think if these markets really prevail, like DLT-based CSDs really prevail, I think there is a need for settlement in central bank money. Now, the settlement could potentially be in a tokenized form of central bank money, but it could also be kind of, and there are different experiments out there, kind of trying to link existing payment systems, so existing RDGS systems with tokenized platforms, so to settle the cash lag in traditional reserve balances in the RDGS system. So there are different options, but yeah, probably as we have found, but also others have found, there are huge challenges when it comes to settling cash lag and tokenized assets on different platforms. So integration is very important, in fact. Now, when it comes to retail, I'm not so sure. So I clearly see there a room for stable coins, and I mean for tokenized commercial bank money, whatever the exact characteristic is. So yeah, so I wouldn't exclude stable coins from a future ecosystem.
I guess that's music to your ears, Rom. What's your your take on that, and also I'd be interested to know your views on the cost and, as it were, the number of interactions that Isabel spoke to a few moments ago, and what your observations on that question are.
Thanks, Mark. Yeah, let me just talk to the first question that you asked around stablecoins and their place in the world, and then I'll get onto the business case question. So I think Oliver, well, I basically agree with Oliver in the sense of there's basically two types of stablecoin. They're quite different. There's stablecoins where, yeah, they basically act like low risk. Well, depends on your perception of risk, but they act like mutual funds, and they're backed by something. Those things are exactly like Rob said, they're completely new currencies, right? Because they vary versus themselves and versus fiat currency. And then you have what society is kind of used to as money, which is effectively bank deposits. And commercial bank deposits are typically guaranteed to always be one-to-one with fiat currency by the combination of discount window or lender of last resort and prudential oversight and kind of all the rest of it. And these are two very distinct things in my mind. It's easy to see why, if you come from the crypto space where you're always trading and everything's always exchanged, that somehow this kind of backed coin mutual fund thing makes sense, right? It's friction free to trade in and out, and you kind of know what you're doing, and that's sort of all good, and you're speculating on all aspects of it, but you're basically holding assets. You're not really holding cash in the way that people think about it. It's much more difficult, and this is why I guess people have had problems with Bitcoin. Like that's very volatile, so maybe if it's something more stable it wouldn't be so much of a problem, but it would still be problematic to go and buy like your cup of coffee and all of that kind of stuff, especially if you get into more complicated payments. I think the place that we're going to end up, and this is why people talk about CBDC, is actually more around tokenized commercial bank deposits. But if you're going to do wholesale, then you need to get to something that's very close to central bank money. So exactly what Oliver said, it could be CBDC, or it could be something like what we're doing, which is kind of effectively a synthetic CBDC, but effectively has the same credit risk as CBDC. But you need something that's always one-to-one, guaranteed to be one-to-one with fiat currency to make sure that you can settle all of this stuff. I guess in the long run, I can't see traditional financial markets settling anything in another, basically doing DVD. I just can't see that happening. I think we'll always move towards a kind of DVP world.
Yeah, I understand. This morning's new currency is the Bowie, named for David Bowie, and I can't see us doing settling say OATs in that.
Exactly. I mean, I live very close to Brixton in London, and we have the Brixton pound, which also has David Bowie's picture on it, but it only really works in a few stores around Brixton. So not very helpful.
You run into an interesting question, and we're starting to think about it. Is if one firm in your ecosystem is settling in CBDC and another firm is settling in stablecoin, what is are you managing risk in the right way? And do you have issues of unwinding?
Exactly.
We have a.
Well, sorry, so I'm just going to answer the business case question. So the angle, the angle that you guys were all coming from is it going to be better for the CSDs? Is it going to be cheaper somehow? And kind of all of that stuff. What I would say, given my shareholders, is there are a bunch of customers who it will be definitively better for. So all of those folks basically have to reconcile a whole bunch of transactions with whichever combination of CSDs and then custodians and other intermediaries, and collapsing all of that for the system as a whole, not necessarily for the CSD itself, is actually extremely cost effective, number one. Number two, all of those different people are actually running risk against each other, and so they hold balance sheet against each other. If you collapse all of that down, you also take down all of the balance sheet risk. So while for a specific CSD, I don't know whether it's cost effective or not, especially compared to it. In fact, it would almost be I kind of find myself almost agreeing with Vipin. It would almost be hard to justify it for a single CSD that was just doing stuff for itself versus a normal database. For the ecosystem as a whole, we can see well, at least from the research we've done, we can see measurably that the ecosystem as a whole would take down a lot of balance sheet risk and fragmentation of liquidity that's occurring as a whole.
Super. That's a really interesting perspective, because looking at what you say about balance sheet is interesting. I'd like to come back to that, but we have a really interesting question from the audience, which is regarding sustainability. And this is, what are the sustainability implications of using tokenized cash in whatsoever form versus book entry? And, the one weakness of the trusted party model is, of course, that it can be seen as a single point of failure. So, Isabel, what's your perspective on that? Is there a resilience card to play here? Isabel, I'm afraid we're having problems hearing you there. I'm afraid that's not coming through. Maybe I could just hand the question to Rob while you sort out your microphone issue, Isabel. And perhaps the Grace, you could give us a hand with that. Rob.
Yeah, I think it was one of the Fed governors who said that a coin is only as strong as its issuer. So from a resiliency perspective, unless governments are toppling, I think the technical aspects of resiliency can be worked out. In the United States, at least, there are 13 different Fed districts, and they each have their own systems and data centers, and and I'm sure other countries can build out, and other jurisdictions can build out resilience as well. And at least what I understand, the U.S. Treasury and Fed are experimenting in terms of their CBDC experiments is focused on resiliency and security, and a lot less on decentralization, and a lot more on security and privacy, and ensuring that any exchange of coin is in fact sustained. So, I'm not. I think a lot of people get tied up in the Bitcoin proof of work energy consumption thing, and I think that is a phenomenon that we'll look back on over history and say, oh, that was an interesting use of power and energy. But I think engineering will prevail, and it'll become more effective.
It's interesting that you talk about energy consumption in the minting of coins, because the same charge can be laid, for example, at gold. You spend all that energy digging something fundamentally lacking utility out of the ground, and one interesting question that comes up when we think about the cash leg of a securities transaction is the use of credit in the settlement process. So both central bank money and also obviously commercial bank money settlement systems enable the use, or rather the generation of credit within the settlement procedure itself, typically through the collateralization of existing holdings that obviously generate obligations safely. So will we be able to maintain that credit generation feature if we move to settling, say, on tokenized commercial bank money?
We're all waiting to see who this question goes to.
Yeah.
Assets or on CBDC? You lost me?
Briefly.
Yeah, I think we lost the important bit because we
I'd like to start, if you don't mind, and then everyone can else chime in, because what we saw in the ION experiment
was regarding credit generation and whether that can be retained, or if it cannot be retained, whether that's a good or a bad thing. Apologies, I just wanted to show solidarity with Isabel. So, Rob.
Yeah, look, we did an ION prototype last year, and it kind of aligned with what we learned from our T1 discussions with the industry, and that there was a lot of value to Ledger. There was a lot of value to getting rid of reconciliation on our DLT platform, but the industry felt there was a lot of value to netting, and that when you do, we do 500 million transactions on our busiest day, and we only have 2 million settlements each day. You know, the number, basically the number of industry members times the number of different securities. And you could do that math. And if you're buying and selling and buying and selling, the need for pre-funding is a much bigger issue, and firms, you know, are concerned about that. But then you have the global issues, and maybe that's, you know, really where this thing scratches at, that you're selling a money market to buy an equity. Or when we were talking to our friends in Australia, they were selling Australian currency to buy a US equity. So the intraday credit is an important issue, and it needs to be tracked. And maybe the synthetic settlement coin like Finality is an interesting way of tracking that. And then you eventually settle it in the money of a central bank. But being able to track intraday credits becomes important, and maybe even there's value to those intraday credits at some point. But that's a different question than forcing everything to settle DVP, you know, because people buy what they can't pay for and sell what they don't own. So you have to have some math that works and figures that out.
But the way you say that, Robbie, buying the buy now, pay later features of the system are an externality, a bad thing. But Oliver, would you agree with that? Credit generation creates liquidity, creates resilience. If everybody had to settle in gold, we would have arguably less of a safety valve, a less resilient system.
Yeah, so I think, again, very, very interesting question. And I think we, in our experiments, so both in Helvetia and Jura, we did this instant gross settlement. So this is how, so we experimented with a platform from Six Digital Exchange, SDX, where this instant gross settlement is implemented. And we had a lot of discussions internally on whether this is actually feasible, because essentially all trades need to be pre-funded. This obviously reduces risks considerably, but it may give rise to fundamental changes in intraday liquidity demand, especially, I mean, volatility in liquidity demand would increase considerably, and this could then eventually also be challenging for central banks. So how does an intraday facility need to look like in the future when markets settle instantly? So there are many questions around there, and I don't have the answer. I don't know whether anything close to instant settlement is feasible. Looking at today's arrangements, because
you mean when looking at it from a systemic perspective, and I guess
absolutely
direction. So Rom, you have a view on this.
Maybe on pre-funding, I would like to say something.
Okay, Vipin, go ahead.
Yeah, I mean, pre-funding, we all know that it entails asset commitment risk. So even now, I can do in Mauritius real-time settlement. If you pre-fund your account with me, I settle real-time. So that's a big deal. It's not a system issue, not at all. So I think, again, I think you have to demystify this whole thing. I think very often the debate is being diverted from the core issue. You know, suddenly pre-funding is good because we are doing on DLT, and now currently it's not good because it's on book entry. It doesn't make sense. I think we have to be, I mean, seriously, we have to look at things from first principles, right? Real-time settlement was possible since many years with RTGS Model 1, BIS Model 1, but then we realized that it wasn't efficient because there were too many messages going around on the SWIFT network. So that's why netting brought many efficiencies, and you had central clearing. And if you look at the empirical evidence, if you look at, for example, resilience, I mean, CCPs, CSDs have done very well, even during the crisis, after the crisis, during difficult times. So I don't really see why CCPs and CSDs will no longer be resilient now. Sorry about that. And also about systems. Systems now, with systems, it's so easy to achieve, fault tolerance. So not a big deal. So I think really good to really understand. Frankly speaking, I haven't really seen up to now anything that would convince me, even from okay, let's talk about the stakeholders. You talk about the investors, you talk about the issuers. Tokenization has been around for a number of years. I think currently the market cap should be around 10 billion or more, or slightly more. But it is used mainly for private securities, for bonds, for experimental projects. It is not going mainstream. There are still scalability issues. There are serious interoperability issues. I think Ram probably and Rob will probably know better than me. So yes, let us see seriously how this new whole environment is going to make things better. I'm not talking only for CSDs. I'm talking about for issuers, for investors, for all stakeholders, for regulators.
So thank you, Vipin, the voice of reason, and very compellingly said. But Rom, going back to the question of credit, you've been experimenting this in the wholesale space, and clearly the buy now, pay later feature of both RTGS and net settlement systems today is very, very valuable to your constituencies. So what's your perspective on that? That would, you mentioned earlier that balance sheet costs would reduce. So how do we square that circle?
Yeah, so I think we can all agree that there is some cost associated with having T plus something settlement. And having a number of intermediaries means that intermediary's balance sheet also gets bigger in the intervening period of time in order to provide credit, and that provides risk on both ends of the intermediary for the people that are giving money to them. So the question is, can you do anything about that, or is it even desirable if the way of getting rid of that detracts from something else? And I guess the story I want to tell is one from my past experience as a trader in foreign exchange. And so I see, I'm kind of going into Rob's world of like, he didn't want to predict the future, but I'm sort of saying there might be a future that's different. So in foreign exchange, when I first started doing this back in the mid-90s, the average transaction size was roughly $2 million. There were quite a few trades a day, but it didn't happen that frequently. And then somehow it was settled. I'm speaking as a trader now. Settled somehow in the back end. As the internet developed and we started trading electronically, I saw over the period from 2001 to 2008 transaction sizes go from $2 million on average down to like 50 or 25,000. And what's more is those transactions sped up. So there were, and I think this is also replicated in the equities world. The transaction sped up and the transaction size has gone down. So now you have a situation where the internet has enabled very fast kind of market making and liquidity. You can argue about whether it's desirable or not, but it means that it's easier for people to know what the market price is at any particular moment in time. The big question in my mind is, why wouldn't, if it was possible for the settlement side to do the same thing, why wouldn't you have small sizes settling very frequently? So what I'm saying is actually you could end up possibly with a model where you do much smaller size of settlement, but you do it much more frequently, which means that your net liquidity is kind of the same, or maybe even less than you're currently settling. So yes, you would have more than whatever the number was that Rob talked about, 200 settlements, or sorry, yeah, I can't remember the exact number. It would be, millions upon millions. But of course, today's infrastructure isn't what it was years ago. So today's infrastructure can handle all of that. And if you have a model like that, you actually get the best of all worlds, because you're able to go to something that takes down all of the risk of intermediation, because you're settling much faster. Yeah, and you don't need all of that balance sheet to absorb it all.
So we're approaching the end. Rom, that's an incredibly valuable perspective, but unfortunately, we could obviously talk about this all day and probably all week. But what I'd like to do now is to quickly wrap up and to ask each of you where you would see, or the significance within the market 10 years from now of settling tokenized cash, or settling the securities, the cash leg of a security settlement transaction on the DLT, be it in CBDC or in tokenized commercial bank money. 10 years from now, what will be the reality? Will Vipin be proved right that we'll still be doing things essentially as we are today? Or are we actually going to be transformed in this? Isabel, if your mic is working, I'd like to turn to you first. Unfortunately, no. I'm so sorry that has happened. It would have been great to have had your perspective. So in that case, I'm going to ask for Oliver, for you to give your perspective. Where will we be in 10 years, do you think?
Yeah.
And I'm very mindful, Rob doesn't make predictions, but I'm going to hold his feet to the fire on this one.
Well, I don't know whether central banks are any better in making predictions. Well,
Often
I
not.
guess first of all, well, not any better than anybody else. So first of all, I think it's moving towards kind of a tokenized ecosystem is a huge coordination effort. I don't know where we will be in 10 years. So I could imagine that we will see some infrastructures running on DLT. So by meaning some infrastructure, I mean the regulated DLT-based infrastructures in a permission environment. But there are many open questions. I think one of the questions is really around questions that the Vipin raised during this panel is do these efficiency gains really materialize? I don't know. It's difficult to say. It really, I guess, it will also depend on how exactly the platform and the integration with the rest of the ecosystem is happening. So many open questions, but still I could imagine that there will be infrastructures, regulated CSDs running on DLT and settling in wholesale CBDC. This is of course an option, but not obviously not a requirement.
No, not a given. Not a given.
Yeah.
And Ram, how do you see that? Do you see that it's in the same way, or do you see we're going to be in a different space in 10 years?
Well, I think it's a bit like checking in America, right? You never quite get rid of what was already there, but there will be some changes. And I think there's basically two forces pushing us that way. So the force from the traditional world is there is a need in the banking industry to drive down costs and all of that to make themselves more profitable. It's, you know, the business models in capital markets businesses are quite challenged, basically. And then there's another force that's out there, which is coming from kind of the crypto space. I mean, yeah, you know, we can all believe or not believe in whether it's happening, but there's a wall of money, even in the kind of crypto winter, getting thrown at that stuff, and they are gradually going to find, you know, kind of in the classic Clay Christensen way, find their way up the curve of you know, going from crypto into maybe family offices and like retail investment management and all the rest of it, and eventually find their way into the wholesale space. So for me, there's kind of two forces pushing towards something has to change, and there are definitely answers sitting in that DeFi space.
Got it. Really interesting. And so, Rob, you don't make predictions, but you in line with that or see it differently?
I see there's going to be some essence of I'll say the technology and the spirit that influences what things look like. Like Napster was influential in terms of peer-to-peer, but it didn't have the impact everyone thought it would have. Like, you know, everyone will share their own thing. Why do you need intermediaries? And that's over 20 years ago. I'm not sure the world needs as many cryptocurrencies as are being generated, and I'm really torn, I'll say, about the different or the wrong, if I can put it that way, incentives and motivations in certain communities. There's, you know, everyone you talk to, you know, about their altruistic motives, then you find out, well, they're a miner, or they're selling software, or they're already invested in something. So the purity of intent and spirit and the trust is already, you know, I'll say, other influenced in other ways. Will tokenization? My prediction is that tokenization is a value add here. That the technology under distributed ledger, which will become more efficient in terms of sharing a database, so we don't each need our own version of a database, will take off. Whether it's a distributed and decentralized model or some kind of, you know, mutually agreed upon consensus model in some other way, I think there are different ways of playing that out. And I will also predict that the Fed will no longer have to issue only paper dollars. That, you know, that as much as some people are against CBDC, that forcing the U.S. Fed to be the issuer of paper makes no sense.
No, what you're saying is the core technology, the core concept can be unleashed to make our industry more efficient, not clear in exactly which way. So with that, let's turn, as I was saying, to our voice of reason. Vipin, has the panel convinced you? Yes or no?
Not at all. Not at all. I'm sorry to say that. Because again, it's like, you know, what we call in cognitive bias is confirmation bias. So we want to believe in what we're saying. I think as I said, as a scientist, we have to look at the evidence, and this is what counts. I think bottom line is the evidence, and we just go back and look. Definitely, crypto are here to stay. Cryptocurrencies will stay as a speculative asset class. Whether it's good for the economy or not, I don't know. This will stay, and this space will continue to grow. But DLT as panacea, the solution to all problems that we are having in the CSD industry or post-trade or whatever, I think it's going to be there also. But I don't see this coming mainstream, at least in 10 years, because of scalability, interoperability, legal and regulatory issues. I can name a lot of them, but you know what I think now.
Absolutely. Guys, we've come to the end of our time. That was an extraordinarily rich discussion, not least because we had different perspectives on each of our key themes, be it disruption, cost effectiveness, the role of credit, the form of the coin itself, and the impact on industry structure. I'm so sorry that we lost Isabel due to technical issues, because I know she and Euroclear have enormously valuable perspectives on this question. So it just leaves me, and on behalf of the audience, to thank you all for your time and for sharing your enormously valuable perspectives. And I'm just so impressed by how much practical experience and thought we've gained from this. So thank you ever so much to all of you.
Thank
and
you.
With that, Bruce, I'll hand it back to you.
Thanks, Mark, and thanks to all of you for what was a fascinating discussion. It is great when we can have a panel like this of informed individuals that have different perspectives. It really livens up the discussion. We're going to take a brief break now and come back for a panel on cyber resilience, obviously a very, very important subject to CSDs around the world. So it is 25 after the hour at the moment. Can we come back for the next panel at 20?